Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Yang, good afternoon. Thank you for coming on today.
Happy to be here.
Well, let's start with some headline news on inflation. Consumer prices in the U.S., as we heard a minute ago, up by the most in almost 40 years last year, 7% from a year earlier on the Consumer Price Index. The expectation is that this will lead to higher wages and so forth. So tell us about inflation in the U.S. and your outlook.
Okay, well, as you mentioned, the monthly inflation was 0.5% in December. This is actually a bit of good news because while it's still high, it is down significantly from the past few months. It was 0.9% in October and 0.8% in November. So there are some indications that perhaps the inflation, while it will be continually be high, will not get higher as the year goes by, which gives some hope that the inflation will be reduced. Maybe not this year, but perhaps next year. This is what a lot of projections are saying. The December Fed report has said that the Fed FOMC members believe that the personal consumption expenditure inflation index will rise by 5.3% in 2021 last year, but it will rise only 2.6% this year and 2.3% next year, 2.0% in the long run. December's survey of consumers had inflation expectations running at 6.0% for 2022, but 4.0% on the average for 2023 and 2023 to 2025. And perhaps most importantly, if we look at Treasury's inflation-protected security bond prices versus unprotected bond prices, the difference of which can be used to calculate the expectations of future inflation that's embedded in these prices, the inflation averages at only about 2.5% for the next 10 years. So at least so far, inflation is expected to be relatively temporary, though it might last throughout this year and perhaps part of next year as well. The big concern is that if the inflation runs for a long time, inflationary expectations will be bumped up, and that will mean higher inflation for a longer period. So all of these just gives stronger case that the Fed should engage in contractionary monetary policy and the loose monetary policy as quickly as possible, and then raise interest rates. So we may see a rapid increase in interest rate over this year, perhaps even more than 3 to 4, which are currently expected, and we may even see rate increases at higher than 0.25 percentage point at a time.
Well, though inflation is running so hot, Professor, stocks on Wall Street closed higher on Wednesday. Tech shares recovering from their big declines. Of course, the day before, investors got a little more certainty from the Fed about rising interest rates. What's the story in the global markets?
Okay, well, the markets seem to have shrugged off Chairman Powell's testimony, which said that the interest rate may rise more than expected and quantitative tightening may begin as early as December. And the Fed did not rule out, as part of the quantitative tightening policy, directly selling off the bonds which are held by the Fed. So the increase in the stock market broke a 5-day losing streak before the testimony. And the market interpretation is that while he did say that it is likely that interest rate will rise faster and quantitative tightening may begin in December, he did not commit to it. So they are taking that as good news, that perhaps it will not be as bad as previously expected. And some analysts are arguing that market is distorting the testimony, hearing or interpreting the testimony that they in a way that they want to hear. But anyhow, after Powell's testimony yesterday and today in the United States markets, the stock market went up, and they're now Dow and S&P are less than 2% below their historic highs, and the market already seems to expect at least 3 or 4 rate hikes this year. The European markets rose on Tuesday and Wednesday following the U.S. rally. But futures for Thursday, both in the United States and in Europe, are slipping. Presumably because of the inflation figures, though even after the inflation figures were announced yesterday, the U.S. market did go up. Asian markets rose on Wednesday following the U.S., but it shrank or is shrinking today. And again, the market interpretation is that the inflation of 7% in the United States, while it was not exactly a shock, is still negatively affecting the markets.
Well, Korean stocks started out higher today, too, but those gains were gone by mid-morning. We did see some strength in shares of LG Electronics for one, also Hyundai Steel with a gain today. Tell us about the domestic market.
Okay, well, Kospi was down 0.35% at 2,962.09. Individuals and institutions sold. Foreigners bought. And again, the interpretation seems to be that the 7% inflation is too high, and the market is worried about that. You mentioned the LG Chemicals. LG Chem had been under a bit of a controversy in the last few months because they had decided to spin off LG Energy Solutions, which makes automobile batteries for electronic vehicles, and that had really angered LG Chem stockholders who argued that LG Chem has spun off the most promising area of profit under the LG Energy Solution banner, and this would benefit the Chaebol family owners rather than stockholders. But LG Chem has reported that it made 1.6 trillion won worth of revenues based on electronic battery-related materials, which they are still keeping under the LG Chem banner. So the profitability of that sector is expected to rise. LG Chem expects 2.8 trillion won revenues for that area in 2022, rising to 7 trillion won by 2026. So this seems to have alleviated the concerns of the LG Chem stockholders and perhaps even justified the spinoff. Kosdaq, it was down 0.82% today, and it ended at 983.22. Individuals bought, and institutions and foreigners sold.
Well, finally, Professor, as we heard a minute ago, the Korea Economic Research Institute is warning about the tax burden for future generations if the pension system isn't reformed. Specifically, it says under certain conditions, people born in the year 1990 won't get a penny from the national pension when they retire. Someone that age currently, it should be said, is eligible for the pension at age 65 or a smaller amount if they take it at age 60. What's the status of Korea's pension system, and what could be done to make sure it's solvent?
Okay, well, giving some numbers behind the story, by 2045, the share of old people will be 37% of the population, and this will be higher than the current number one, which is Japan. And currently, the poverty rate for the old is the highest in the OECD at 40.4%. Part of that is because of the low interest rate that Korean economy had in place since 2008. People who were retired, who had put their money in savings account, depending on interest income to get them over the retirement, their interest income has been cut so much that they've been driven into poverty. Meanwhile, people who bought buildings as a retirement plan, renting out buildings in their old age, they're doing really quite well. This is one of the reasons why the current demand for buildings and housing units are so high, because it has proven effective. So the public pension going broke, that's not exactly new news. We have been reading similar reports about that for 10, 20 years. And the Korean Social Security system, as mentioned in the last story, is problematic because Koreans pay less as a percentage of income into public pension, but they get their payouts out earlier than most other, especially European countries. Koreans can get their pension usually at 65 years old. They can even get it younger than that. That's because Korean workers often are pushed out fairly early. In large companies, you have to retire from the companies at mid-50s, and in smaller companies, you're usually pushed out of the company when you're in early 60s. So the obvious solution is to extend the retirement age as well as increase the payments to the pension system. But this is creating a lot of conflict of interest. Younger people do not want older people to stick around longer because they feel that that means less jobs for the young. Companies do not want to hold on to older workers because their productivity is falling, but their wages are going up because in Korea, the longer you stay in a company, you get paid more as a cultural tradition. And then for the older workers, well, if they have to take a pay cut to remain in the company, they don't want that. So there's a lot of resistance to cutting pay for older workers. So we're in a situation where we really need to extend the retirement age, but the political considerations, the conflict of interest does not allow us to do so.
Well, it's a fascinating issue, Professor, and great to hear from you about that. So complicated with the cultural issues at play there as well. Thank you, as always, for sharing your insights with us today. We appreciate it.
Thank you.